for the purposes of we've got people online on LinkedIn, Facebook, and Twitter also attending the event. So for their sake, it makes sense for us to use the mic so that they can hear us clearly. All right, here's one actually, Eric. Great. So welcome to our first gathering in over 2 years now, and it's so good to see faces again. We've continued holding sessions online. That is, if you've continued to have, but then we've been doing them online and running webinars. And because we all like to complain about bandwidth, we haven't seen your faces. We're like, you all come into meetings and then you don't show us your faces. So it's so good to see faces once again. So we're hoping that we can, COVID behaving itself, we can continue to build up and hold more sessions going forward. And just like to welcome everybody who's online, and we're just about to get started. So I'd like to welcome Eric back to Zambia. Eric Osiakwan is the managing partner for Chanzo Capital in Ghana, and he's supposed to be here with Barclay from FinAccess, who's still making his way through, stuck in traffic somewhere. But we thought that despite that, we've got an amazing set of entrepreneurs here, so we thought we could still have the conversation started around investing in how to raise capital, because the investors here. So let's get that conversation started. So so as I say, welcome. Let me sit down at least.
Yeah.
Haven't done this in a while, 2 years. So as we're getting started, Eric, great. So before we get into the conversation around raising funds, who should be raising funds, and that kind of thing. Who are you? How did you get into investing in companies? Why are you interested in investing in companies? But what's your backstory? I think we're keen to hear that.
Right. Thank you very much. It's an honor to be here. And first, I want to apologize that we're starting late. We have to try and do away with the Africa time thing. So apologies for that. So I'm here with one of our portfolio companies, FinAccess. And the company is expanding to these markets, and then we're also looking to invest in local entrepreneurs. But part of what we find very important is to help develop the ecosystems in which we invest in. And one of the things that we've seen is that there's an information asymmetry between we investors and entrepreneurs. So these sort of sessions are to help sort of deal with that information asymmetry. And then secondly, to try and create an opportunity for networking. Because eventually the mantra in investing is that you back the jockey, not the horse. So you invest in the entrepreneur, not the business. Right? So the more you can know an entrepreneur, the better you can invest in them. But we have background. So I was an entrepreneur many years ago. Actually, I had a stint here in Zambia in probably 04, 05. With a friend of mine called Godfrey Chikumbi, started a company called SmartNet that builds fiber. Maybe some of you have heard about that company. So around 05, 04, 05, 06, I was hanging out here quite a bit. So it's exciting to be back here many years later and seeing Bongo Hive. I was here in November last year with the Zambia Business Angel Network that is forming. So it's great to see that there's an angel investing community that is forming. Generally, there's more entrepreneurs than investors, but we want to try and see if we can catalyze the investing side of the equation. So we did, Simunza and the other member, we did a session with the investors, just trying to get people to understand how you get into investing. So I got into it accidentally. 15 years ago, I never knew that I would be an investor today. So I'm not an investment banker. I didn't come from the reals of Wall Street or anything like that. I was just an entrepreneur. I helped build a couple of ISPs, internet businesses, in my sort of what I call my first career. And then I got in building subsea cables. And I managed to exit some of those positions. But when I was an entrepreneur, it was very hard. And I presume it's not easy for anyone here as an entrepreneur, right? But along that journey, you meet people who help you to achieve certain milestones or help make it a little bit easy. Either they are investors or the people who advise you or your mentors or your friends, right? So that's how I managed to make it. And so I always wanted to be able to pass it on. So one of my big dreams was that I want to make it easier for the next entrepreneur. So I also started by advising some entrepreneurs. Actually, some of them came, by demand. And then, then a month comes, they can pay salaries, so they need to buy a printer, they need some money to do something. And luckily, I was in a position to be able to help. So then I started kind of putting a little bit of capital to play. And one of my good friends, a lady called Esther Dyson, who's a very famous global US-based angel investor. So one day I was sitting with her and saying, well, what you're doing is angel investing. And actually, that's the way I started. You have been doing much better. And I realized I loved it, and I could do it some more. And so long story short, started Chanzo Capital, try to set up a structure that allows me to do this more formally. And then we launched Angel Fair Africa, which is an event that we do every year to bring entrepreneurs and investors together, because we cannot invest in all the entrepreneurs. But we figured that if we can create an annual event that allows entrepreneurs and investors to meet, we can make deals happen. So we launched this in 2013 in South Africa. I mean, 2013 we were trying to do this, we were like, what are you trying to do? And today, so we've been in the pioneering stage of sort of creating this entrepreneurial vibe across the continent, driving investment. Today, Africa has a lot of unicorns. We started with what we call the King's countries. So I wrote a book on what I call the countries that started this innovation: Kenya, Ivory Coast, Nigeria, Ghana, South Africa. Today, Zambia is one of those countries. The ecosystem is mature. It's exciting to sit in a room with all you entrepreneurs. And we're seeing this in Senegal, we're seeing it in Morocco, we're seeing it in Egypt. So it's exciting to see the continent breed entrepreneurs. And hopefully we can bring the allocators of capital to the table. It could be a very exciting adventure. So that's, I hope it's a good enough summary to understand context and how we come into this.
Oh, great. Thank you very much. So picking up from that, what I'm picking up is you start off as an operator yourself, and as an entrepreneur, you build a business. Did you exit that business?
Correct. Exit a couple of ISPs. That is how I could actually start doing this, luckily with my own capital.
Oh, great. So for the sake of everybody, exiting is when you're able to sell off the business or very often allow the investors to get their money back out of the business. And something that, I guess in your opinion, something worth considering at the beginning when you're looking for an investor is where the opportunity for exit is going to be. But curious, out of that, why did you choose to exit? Why didn't you choose to keep the businesses yours for, I don't know, for your lifetime, for the next generation? We still need internet service providers. So why did you choose to exit?
Actually, I didn't plan to exit, but one of my sort of gifts in life is I'm able to see the future. It's sometimes I actually don't know it very clearly, but I can have some line of sight, and then I kind of, in America, so you follow your nose, right? So one of the things that happened was when we started building these internet businesses, around the same time was when the mobile explosion happened. But if you remember, the mobile operators were not connected to the internet. They just give you a mobile device, right? And then you talk on phone, so it's voice. And then we built the internet track. But immediately the mobile operators started doing internet, I kind of immediately realized that we were going to be out of business. The reason was that for me, I remember I had this aha moment. I said, okay, I have a phone, I have one device, and then I have another device which gives me internet. So normally we'll give people some form of wireless connectivity, right? So either a modem or we bring some device, some Visa terminal or something like that. But immediately the mobile operators started doing internet, and they started with this Edge. Edge was the first, I kind of said, well, think about it for a minute. If that same device that I have that allows me to talk and allow me to connect to the internet, most likely we will lose the fight to the mobile operators because they will become more sticky. Simply because most Africans want to talk. So they will not leave the phone and then stick to our device. So this kind of was something that I was able to process very early. And so I went to my partners in the various ISPs in which I was. and then said, look, we need to change tack. Either we sell, or we need to start moving in what I call value-added services. So what do you give your user beyond just internet? Because that primary internet that you provide, now the mobile operators will be able to provide that. So they're going to have an edge over you. This is a very simple conversation to have now, but then it was a very difficult conversation. I remember there was one ISP that I was in, and we had a board meeting, and I made this presentation. They laughed me out of the board meeting. They said, well, you're a minority shareholder, and this thing won't work, and we're the big boys in town. This was in January. By December, that business had collapsed. Because the two big mobile operators in the market came in with a go-to-market strategy where they said, activate your voice line, you get internet for free. That was it. All our customers migrated. Because, I mean, I can activate my voice line and get internet for free. And you are telling me to pay, those days we're charging 1 megabit was $12,000, some kids $5,000, So that's how I kind of got into it. So I wasn't really, so it's by accident, but somehow I kind of figured this was what was going to happen. And now we're going to see another iteration of this, sort of with the mobile operators. And to some extent, this whole internet thing, startups, the application layer kind of saw it also, and started dabbling into it.
Oh, great. So talking about, now that you bring, which is actually going to be my next question. So we start off with infrastructure being the first to play,
right.
Then service providers starts to
Which
get
application layer, right? So,
Oh, yeah.
so we build the network layer. So most of what you're doing now is sort of what we call the
application layer, yeah. So coming into the application layer is opportunities that can be built that make use of the internet, and so like the startups that you're building that make use of the internet to provide new products and services to that. So what's your, since you're able to see into the future, what's your what's your play for the opportunity for growth at the application layer? Are we in the mid? Are we starting? Are we going towards the end of the curve with regards to the application layer in Africa and the opportunities that are there? Yeah.
No, actually, we are sort of past the prototype stage, in my view. The reason is that if you look at the African market, it's pretty much an underserved market and also a developing market. So there are two elements. You see that online is becoming a lifestyle, but online business is not yet the thing. And so in our teaser, the thinking is that you want to drive towards entrepreneurs or businesses that are creating that momentum, that are getting online business to happen. Because now people are mostly kind of clear in their mind that, I got to be online, right? Either they're consuming Facebook, Instagram, doing some stuff, right?
Yeah.
But very soon, the demand is people want to use that online to deal with challenges that they face, right? So either they want to fix some friction, they want to fix a pain point, they want to deal with some bottleneck or that type of stuff. So we look for entrepreneurs, and here's sort of the first advice that I believe if you want to build a company at this stage, you want to look for that sort of challenge. So there's some friction or pain point or bottleneck, and you want to figure out how do I use technology that everybody has to kind of solve that problem, right? And a lot of that, it deals with two segmentation. So you can do that for sort of the middle to upper class, or you can do it for the middle to lower class, right? And in our thesis, we believe that we as a fund fundamentally believe in what we call blue ocean strategies, right? So you want to go into markets that are uncharted. And it's not easy, it's very hard. But if you're able to conquer, you become sort of the kingpin, right? So if you look at the company that we invested in, so FinAccess is a company from Kenya that essentially looked for how they can build technology to deal with the SACCOs and cooperatives market. Now, as we all know, savings and lending is an African.
So SACCOs, for the sake of everybody, in case anybody doesn't know, SACCOs are the equivalent of village banking and community level savings groups. Yeah.
And I'm sure here you have it in the, either you belong to a family, cooperative, friends from school, or community savings. It's very, very informal. based on trust. Most of it is no paperwork, but there's a strong element of trust. You're able to put money together, save, lend to each other, support each other's business, that kind of stuff. So FinAccess decided that if we can build a technology layer for that sort of business, there's a huge market across Africa, right? So that's why we invested. So that's a clear case where you're using technology to reduce the friction, because in that market, the biggest friction, there's no data, right? And everything is very informal. So if you're able to build a technology stack for that, you become the main repository of information. And one of the key drivers for that was mobile money. The fact that most people were using mobile money meant that they were kind of comfortable with some level of technology. So if you can then say to the circles that, okay, you already use mobile money, now you can extend that to the lending activity, to what you do. Barclay talks about this much better than me. I hope he will show up soon. And that's why I wanted to have this conversation, because for us, when we invested, there was a very clear line of sight on how this business can become a Pan-African business. So now, last year we became profitable and became market leader in Kenya. And then we launched into Uganda. And now we're launching into Zambia, right? So the next phase is, how do you take this into multiple markets? And so sort of that gives an idea of sort of what we see as the present. What do we see as the future? We think that big data and all these new technologies, metaverse, virtual reality and all this stuff is going to have an impact in Africa. But most Africans are not online. Most African transactions are still not happening online, right? So there's almost like we are one step behind. But we see that both as an advantage and disadvantage. The disadvantage is that we are not active in the developing of these new technologies. But the advantage is that those guys can make mistakes, and we can learn from their mistakes. And because we can learn from their mistakes, we can actually leapfrog forward. And this is where the context is very important. The way you apply technology to a society is extremely important in how you execute a business plan. So we focus a lot of our energy and our resources on understanding the terrain, the context. Because if you don't understand the context, you misapply the technology and it won't work. And then you say technology doesn't work. Or in most cases, a lot of international businesses coming to Africa and they say Africa doesn't work. It didn't work. It's not that Africa doesn't work. It's that Africa works in a certain way, but you didn't get the patience to understand how things work. Right, so this trip that we've come with FinAccess, this is our first trip, and I came with a team that's 4 colleagues, sort of the CEO, the CTO, the product lead, and the special project lead. And what we spend today doing is talking to the ecosystem players, just trying to understand how does the circle cooperative market work in Zambia. And it's different. It's different from how, based on today's conversation, we've seen how different it is from Kenya. So we will not be able to apply our technology the way we did in Kenya here. But if you came and said, oh, we are market leaders in Kenya, and it works like this, so we're going to pace it here, you miss the point. Right? So this is a very important nuance that if you don't understand about Africa, it's going to be very difficult for you to scale up in Africa.
Yeah, and I was going to come back. Yeah, I'm going to use that now to get into, like you said, you back the jockey, meaning the founding team or the founders. You look for good founders that you can back, and that there's one question there is why do you look for the jockey and not necessarily the startup? Because everybody would think that, oh great, somebody has $1 million idea, or whatever the case may be, but you're more interested in, is this a good entrepreneur, right, as opposed to, is this a great idea? But then obviously you also look at the idea, right, if you decide that you're going to do that. But why you're looking for startups to invest in? Why do you prefer to first assess the founding team or the founder?
Correct. Very good question. So this is a very important foundational question. So generally, when you're investing in an entrepreneur or when you're an entrepreneur, there are 3 cardinal things that happen at the early stage of a company. There is normally a problem you're trying to solve, right? So you see a challenge, you had a terrible experience, and you said, okay, I should solve this problem, or a family member or a friend, and you were, So generally, entrepreneurship starts with trying to solve a problem. So as we say, necessity is the mother of invention, right? So the more necessity, So that's one. And then two, you then want to assess this problem I'm trying to solve, how big is it, right? So you want to see the reach, and that speaks to sort of the future that you're trying to build. Is there a real future in this opportunity? Now, between those two is execution. So how do you, so you dream. It's almost like, you sleep and you have a dream, right? But you now have to wake up and actualize that dream. And that execution has more to do with the entrepreneur or the founding team. Right. So look, everybody has an idea, right? I'm sure if we did a run in this room, I'm sure at least everybody had one or two ideas today. The question is not that you had an idea. The question is who is able to actualize the idea, who is able to take a step. So in Chanzo, one of the things we say is that entrepreneurship is not a contest of ideas. We get entrepreneurs who write to us and say, I have this idea that is great, it's going to change the world, but I need you to sign an NDA before I tell you. So, okay, good luck. Because that idea you had, probably the 10 people who had that idea before you. I mean, Facebook is not a new idea. I mean, there was a company like Friendly.
Yeah.
I don't know if you remember High Five and all this, and all didn't work, and somehow Facebook worked. Right? Why did Facebook work? There are kind of three elements. One, in sort of the modern context, one is that you need to, as a team, you need to have a team that can execute, right? You need to have the ability to take that and actualize it. But the second is what they call timing, right? So you need to be able to figure the right timing to enter into the market. And that goes also with your market entry strategy. Now, these three elements I just talked about all has to do with the team or the founder, right? So that's why we say that eventually when you're an investor, you are looking to back somebody who can execute, who has the ability to transcend beyond the idea and actualize it. It may be a sole founder, it may be a co-founder, it may be a founding team, maybe 3 or 4 people. But as an investor, you're spending most of your time understanding the opportunity, and most of the time you can get, the opportunity, you can get the market. The hardest part of this exercise is figuring out if this entrepreneur can execute. And that's not easy. Because, you don't get to know someone by, one meeting or 2 meetings or 3 meetings. And this is where the third part of this is that it's an element of luck, or, some call it, gut feeling, or, stuff that you don't, it's less scientific, right? So you look at all the data, you think, okay, I want to take a bet on this guy because I think maybe he can do it. Right? So as an investor, you also take a leap of faith in that exercise of backing an entrepreneur and believing that this person, and it's a combination of either the expertise or the experiences of the person, right? There are certain sectors where if you don't have experience, for example, healthcare, we all saw the story of Terranos, right? I mean, she was an amazing lady, but that's an area that you need a certain level of scientific knowledge. You would disrupt that space. So if you came to me with a healthcare idea, I want to understand that you understand healthcare, you understand medicine. Because if you don't understand medicine, it's hard to disrupt it, right? You can think I can just do something that works, but you have to understand how medicine works. And in the industries where you can disrupt, you are better at disrupting if you don't know the industry, right? So these are the things that an investor, so you play around with in your mind when you're talking to an entrepreneur and try to figure it out. And this is why a lot of the exercise is about the entrepreneur. But it's an exercise that you can't complete. There's no completion, right? So every investor sort of, you build a certain level of comfort with the entrepreneur, and then you then say, okay, I want to take a leap of faith with this person. I want to back this entrepreneur because I believe that based on how I know the person, the data sets, and what I've looked at, this person could actually make it work. And even I could get it wrong.
Yeah, great. So yeah, great. Yeah, no, that's actually quite vital because then founding team working on a problem, and that's a good thing. Is like a problem worth solving, so that you actually know that there's a future in solving this problem, and that there's a market opportunity that can be looked at within there. Now, there are phases that we like to use when we start to use startup jargon and all kind of stuff, where we say, okay, great, are we finding founders that are investor ready, and stuff like that. And Tommy, who's a friend of, who's a mutual friend of ours, he's got a phrase that he uses, and he says he's an angel investor as well, an African angel investor. And he's got a phrase that he uses where he goes, but is the startup investor worthy? So talk to us about what makes a startup investor worthy.
Yeah. I mean, Tommy Davis is a great angel investor as well. He's the president of the Africa Business Angel Network. As Simuza said, a very good mutual friend of ours. And has been also a pioneer in this space when we started many years ago. So he's right. It's a two-way street, right? We, the investors, spend a lot of time trying to assess you, the entrepreneur. The same way you, the entrepreneur, also need to spend time assessing the investor. Unfortunately, a lot of entrepreneurs don't do that. And so somehow the equation is somehow skewed against the entrepreneurs. Part of that is because of scarcity in the market. So there's not a lot of investors, right? Actually, there's an entrepreneur that I'm working with in Zambia. And, you know, he got an offer from an investor. And I said, well, this deal is really bad. But his answer is that this is the only deal I have, so I'll take it. Right. And I said, well, I can understand where you are, but you also have to understand that the same way if you don't raise money, your business could fail. Raising money from the wrong investor can also lead to failure. So raising money alone is not the entire solution to the problem. And one of the ways you can diligence an investor is simply talking to the entrepreneurs that invested in. It's a very simple exercise, but a very important exercise. The way I interact with the entrepreneurs I've invested in is most likely the way I will interact with you or treat you as an entrepreneur. So doing that exercise, and it's your fellow entrepreneur. If you call him, he will pick up, right? Or you send an email, you DM the person. So, how do you find your relation with Eric, right?
Yeah.
I mean, we tend to be a bit more involved when we invest with I think I'm still very entrepreneurial, but I don't take a management role. We come in as a non-executive principally. But like with FinAccess, what we're doing here is that because I know Zambia, I have been here before, I know people. So FinAccess is leveraging my network to enter the market, right? So it's important for you to assess the investor beyond what the capital they're able to provide. Because a lot of the time we kind of get a bit stuck with, once I get the money, everything is solved. But actually, there's more to building a business than the money. Yes, I'm not saying money is not important. It's a very important part of the equation. It's the fuel, right? But after you've figured that out, there's a lot more that needs to happen. So you want to think beyond the capital and say, is this an investor who will be able to help me with the things that I'm not able to do? Can this investor complement my efforts? Because you see, when an investor gives you money, obviously they want a return on the capital, right? And the only way that an investor gets a return is if you succeed as an entrepreneur. Now, for you to succeed as an entrepreneur, there are factors in your control, and there are factors way out of your control. I've invested in entrepreneurs that failed primarily because the market was not ready, or they got into the market at a different time, or there were factors outside of your control, right? And even with that, yes, an investor cannot help you with all the factors. But you want to be sure that the investor is able to help you with things that are critical to your success, right? So you want to have the investor on your side of the table. Fortunately, someone says, he gave me money. Okay, you sit over there and I report to you, okay, 3 months time I'll come and tell you that I said I would achieve these targets. So I've achieved them or I couldn't achieve them, right? It's one way to look at it, but you realize that when you now start having challenges, what you really want as an entrepreneur is your investor to be able to help you in those challenging moments, not to compound it. And part of it is when you have that relationship where you give the investor visibility into what you're doing. A lot of entrepreneurs think that keeping the investor away is the best way. No, because the reality is that building a business is hard. Trust me. I can't say this enough in the room. There's so many factors you want to deal with. So you want to have all the help you need. So trust me, it's important that you always have a good relation with your investor. You can call, I mean, all the my entrepreneurs, they're the only people who can call me anytime. I tell my entrepreneur, you call me anytime, of course, so long as the phone is close to me, I will pick up. In the middle of the night, somebody you want to talk to, you're having a challenge. Because I know that you're dealing with a lot of issues, to succeed. Even when the business is growing, you have a lot of challenges that you have to deal along the line. And so you want to be sure that you're on the same side of the equation with your investor. So it's important to do that sort of cross-referencing and make sure that this is somebody that I can hang out with, somebody I can have a drink with, somebody I can share the issues with, right? Because the entrepreneurship journey is hard and it can be very lonely.
Yeah, okay, great. So let's talk process. So now I know, okay, great, there's Chanzo Capital, there's Kukula, there's whoever, the set of investors that we could possibly be talking to. I don't know about Ghana, but everybody talks about, if you read traditional literature on startups, you talk about friends and family, angels, then VC. How strong is the friends and family network in Ghana?
Yeah.
Zambia non-existent at the moment,
yeah.
But
yeah, hopefully we can try and change that. So when you start a business, right, the biggest challenge that you're dealing with is to bring around people that know you. Like we said, you're investing in the entrepreneur. So there's a phrase of the early stage investors: family, friends, and fools.
yeah.
Now, the family you have a relationship with, the friend you have a relationship with, the fool, the reason why the last F is a fool is somebody like me, who doesn't have a relation with you. So I didn't know you before, but somehow, okay, we met in Zambia, we connected, and I think that you can make it work, right? So I'm kind of on a fool's errand, so to speak, right? And the reason the first two is family and friends is that, when you have an idea, you're trying to make something happen. Most likely, the people that will invest in you are people that know you, right? So the first set of people you should look for when you're trying to raise money is that category. An uncle who is, well-to-do, maybe he will invest because, okay, this is my cousin. Okay, he's finally come up with an idea. This thing looks, I don't really understand this tech thing, but if John is trying to do this thing, maybe he will succeed, right? And the reason he's investing there is he doesn't get the idea. It's like, okay, he's been working in a bank for a long time, and if he quits his bank job and to start something, maybe this thing could be interesting, right? So he kind of takes a calculated risk, but the fundamental of that calculated risk is the relationship you have with him, right? So worst case, he will say, okay, at least I back my car. If he doesn't succeed, I will say, look, I helped my cousin when he wanted to be an entrepreneur, right? Your friends you went to college with, you finally come up with an idea, so they know you went to college, or you grew up together. You finally come up with an idea, so, oh yeah, Sid finally came up with this idea to go to space and, be the first Zambian entrepreneur, which is very audacious, right? Part of it also is that, wow, this thing could not work, but if he gets it right, wow, this could be very, so maybe I want to be part of it, right? But fundamentally because, there's some relationships, so, yeah, Sid is known for kind of coming up with these crazy ideas. Okay, the first two didn't work, but maybe the third time it will work, right? And if it works, then it's an outlier. So trying to play within that space is very important. But your family and friends will not have the big money, and this is where you need to also sort of adjust your expectation and what you want to build. So that first family, friends, and fools, they give you the money that you need to just take that idea and build a prototype. Or in the tech world, we call it the minimum viable product, right? So finally, sort of substantiate what you say you are trying to build, right? So don't ask him for 1 million, because your uncle doesn't. If your uncle gives you his 1 million, this is the entire world. So he won't give you the entire 1 million. Yes, you eventually need 1 million, but if you ask him for 1 million, he won't give you 1 million. But to build a product, probably all you need is somebody to write the software. So a software programmer that you want to pay for 6 months. Right. So you figure out, okay, you got to buy a laptop, pay him some salary. So maybe that will come to $50,000 or $100,000. So start with that. So tell Uncle, if you give me $50,000, I'll be able to come back in 6 months and show you an example. Now you can feel what I'm talking about. See, what you've done there is that you've reduced the risk, right? So, your uncle gives you, or your friends say, okay, we'll put money together. Okay, we have this savings scheme, students. Okay, all right, let's give Simunza the 100,000 that we've all saved as a student group, So, okay, we'll give it to you 6 months. We want to see what you've developed. Then you go, you apply yourself, and you make sure that you get that product, right? You get at least that prototype, that thing that you say you can show. Then you come back and say, yeah, I told you I can make this mic move from here to here. Now look, leave it here to move, right? So what you've done there is that you validated your idea. You've risk adjusted that option, right? So suddenly uncle say, oh, okay. So you were able to, or your friends say, okay, actually, he was really able to move the mic, do something that makes the mic move from here to there. So now you say, okay, I want to now go and find customers. Now I need to find I need to hire 1 or 2 more people who are sales and marketing people so that they can go and sell this product, right? If you had money, if I came back to you, would you most likely give me that money, isn't it? If I came back and said, okay, I want another 100,000, and you could find 100,000, would you give it to me? You most likely will, because I've proven the first part, right, that I can build a product. So you need to apply that same thinking, right? And that's why it's important when you think about the money you need to build your business, yes, you eventually want to get 1 million. And here's the typical mistake that a lot of entrepreneurs make. They say, my idea is like Facebook, and Facebook is worth 10 billion. So my company is worth 1 billion. Well, so I can give you 1 million. Yeah, I get, you've just projected a future. But the reality is that you're not Facebook. Facebook has, 3 billion users. There's nobody using your thing. You haven't even done anything. So if you say you're worth 1 billion, yes, you could be worth 1 billion because you're building something like Facebook, but you're not. And then if you ask your uncle for 1 million or your friends for 1 million, first of all, they can't give you their 1 million. If they had 1 million and said, why would I give you 1 million when you haven't been able to build something? Right? So it's important for you to step back. So you want to build that Facebook of the future. But you as an entrepreneur need to walk yourself back and say, what is the first step that I need to build to show that I can get to that Facebook, right? Or I can get to that big idea. And therefore, what do I need? So I talked about minimum viable products. So you need to also think about what is the minimum viable capital that I need to be able to actualize what I want to do. And once you do that exercise, you realize that yes, you eventually need 1 million, but you need to start with 50,000, or 100,000, right? Or 150,000, right? And then prove this first point, and then go to the next, then get 1 customer, get 3 customers. Then now you said, okay, I want to build a sales team that can get 20 customers, 50 customers. So now I need 500,000. Of course, there's certain ideas where you need 1 million to start. Let's say you're doing scientific research, right? So you have to do you need to go to a lab. You need to buy lab equipment, So the numbers vary for different industries. So if the industry in which you are, the minimum you need is 1 million because you're doing space research, right? You need a certain level of equipment and things. So it's understandable. But what I'm just saying is that you need to calibrate carefully what is the minimum you need to get started with what you want, and not what you eventually need to get there. Because the reality is that, and the last part of answering that question is that when you go this way, then because you don't have any revenues, it's difficult to value the business. And this is where the entrepreneurs that take the first approach, this is where things fall apart. So they say, okay, my business is worth 5 billion because it's like Facebook. And then the investor says, no, you don't have 3 billion customers, so I can't value at 1 billion. Then the conversation falls apart. Because he's saying, but you don't have any customers. You don't even have a product. So why would I give you that 1 billion valuation when there's no proof? But if you are a second-time founder, let's say you've built a company before and you exited that company, then if you come to me and say, my idea is I'm able to, this is what they call track record. So sometimes I can give you that validation because you have a track record. You built a company before, you're able to grow it, and maybe you exited it, right? And so if you say I can do this, then there's a track record. But with the absence of track record, you have to prove yourself. And that's why you have to start small. And so that early stage, what you do is you normally use what we call a convertible note or a safe note. They are both the same, just that one is a variation of the other. What basically it does is that you avoid the valuation conversation, which can essentially break things apart, because you will be at 1 billion and the investor will say, well, you don't have any customers, so I think you are worth 500,000. Now, between 1 billion and 500, I mean, there's a big space. So the probability that you come to some understanding is hard, right? So you say that, okay, the convertible note is very simple. What it does is you say, well, okay, you say your idea could be worth 1 billion. All right, great. I don't think it's worth 1 billion, but I will say, okay, I'll give you the 50,000, and then you give me a promise that if you get to the 1 billion, then I'll get a certain shares in the company, right? So that's what a convertible note is all about. It's all about saying that you say you could be there, and I'm saying you are here. So let's say I'm giving you a loan. So it's basically like a loan instrument. What it also means is that you could actually pay me back. So you could say, after 1 year, you could say, okay, I've now developed the idea, or it didn't work, so I'll give you the money back. Or Eric is not really the type of entrepreneur, investor that I want to, you're not helping me as much as I want, so I want to buy it back. So at the early stage, you essentially use a convertible note because it allows you to have the flexibility to separate from the investor, where essentially the convertible note has three main terms: the capital principal that you need, a discount on it, and then sometimes a valuation cap. Now, the discount is essentially saying that because you said the business could be worth that, and I'm giving you money now, you're using my money to achieve that objective, right? That milestone. So if you get here, and then Simuza wants to invest, at that point is when I'm converting, right? I'm converting into equity. So he and I cannot come in at the same price because I took a risk that he didn't take, right? So you're giving me a discount. So you say, Eric, you will, first of all, have an interest. You put an interest on amount. Remember, I gave you a loan. The money I gave was a loan. So so we agree on an interest. Normally use the market interest rate, or sometimes it's lower. So let's say it's 18% or 17%. Yeah. So over the 1 year that you've used my money is now 100,000 plus the interest that has accrued, isn't it? Now, okay, you've proven the business. Now you have some revenue. Now Simuza wants to invest. So now we want to put a value on the business. But I took a risk, so now I get a 20% discount. So this is where the discount part kicks in. So now I can invest my principal plus the interest, and then I get a discount. So you see what has happened? So now we've achieved the same objective. And now Simuza is able to invest because you use my money to validate the idea. So now Simuza says, oh, okay, you finally have the product you told me about. Okay, now I can invest. Now the difference between I and Simuza is that he's also an investor, but he prefers to invest when there's something. Yes. He says, my risk appetite is different from Eric. My risk appetite is I can talk to you, think about, assess your ideas. Okay, I think this can work, and I take a risk. So my risk appetite is different. His preference is I want to see the minimum viable product. Then I will give you the money. So that's a difference. So that's an important difference that you need to establish between different investors. What is the risk appetite of the investor? So angel investors take a higher risk generally because you don't really have anything, and they believe in you to be able to actualize something. So once you've then actualized it, now you need to get customers. That's where the venture capitalists come in. That's the next set of investors. We call them VCs. Actually, their name speaks for it. You see, the first one were angels. The reason why they call them angels is that whole experience I just it's almost like an angelic behavior, right? It's almost like, you take some leap of faith. You almost kind of trust the person. It's a little bit informal. Things are not very harsh. That kind of stuff. The venture guy is saying that, okay, now you have some customers, so we can put a valuation. I want to see numbers. I want to see your monthly recurring revenue. Okay, so I can get to 20,000 every month. I can grow by 20% every quarter or every month. And then Simuza says, okay, based on that, if I give you 500,000, $1 million, you can then grow to the 1 million target that we have in 6 months. So here is a 12-month runway. And then based on that, now that you have that, you can have a forecasted financials, and then you can use a discounted cash flow to come with a valuation. So now you see you've got it to a point where now we can value the business. Why? Because now We can see some numbers. We can do some forecasts, so we can value. So now, you see, we solved the problem of you being at 5 billion and I being at 100,000, and we couldn't meet initially.
Oh, yeah, you're great. So actually, you've gone into where I wanted to go with regards to having discussed now all the way from angel up to VC and the different relationships that start to kick in there. So I'm going to open it up to questions. But before I do so, the question I now have is, great. So I'm now coming to you whether you're an angel, I'm coming to you whether you're a VC. I've either got my MVP or my first product out, I've got customers that I can show. So I do the thing everybody talks about, go and put a deck together, and I send it out to say like, okay, great, Chanzo, it looks like a right fit for me. Hi Eric, how you doing? I'm in Zambia and I've been building this startup that turns salt into water, and in the process, and I can see that there's a large market for water based on the following metrics, and the future looks like this. So can I send you my deck, or please can we set up a meeting to have a conversation and I send you a deck? What do you look, what as an investor now, what do you look for in the deck? What are the things that you first go and speak out to you to say, this could be interesting, I want to follow up and have a conversation with this entrepreneur?
Right. Probably there are 2 or 3 things that I look for. The first is I want to see some level of traction. Okay. So what have you been able to do on the idea? Right? Sometimes it's just, okay, I've been able to gather this set of information, or I've been able to take my own savings, and a friend of mine who knows how to write software, I managed to convince him, and in the last 3 months, we have a minimum viable product. Or as one entrepreneur that we're investing here, he didn't build the product. He says, I've got the first set of customers, and I've actually been able to deliver the service to them without a product, and they actually are willing to pay for it. That's very powerful. Because, the reality with the entrepreneurship game is that until you have a customer paying for your business, you don't have a business. Can we agree on that? I think there's a unanimous understanding, right? So one of the easiest way for you to attract and to get an investor's attention, and obviously, like the example you give, I get a lot of emails, right? Yeah. And the first thing I want to look for when I go into the material, I first want to, okay, so what have you done? So it's a great idea, okay, but what have you achieved, right? And a lot of guys say, oh yeah, I describe it, but I want your money to be able to do something. Now, if you believe it's something so much, you should be able to make an effort, right? So look out for what can I do? And there's always something you can do, trust me. There's something you can always do by yourself, through a friend, through your family, through somebody. There's always something you can do about the idea. So figure out a way to make that first one. Then, once I see that, then the second thing I'm looking for in the deck is that who are you able to do that with? Or how are you able to do that? So then come to the team. So I go straight, so I look for the traction, I skim straight, very quickly, and I say, okay, oh, he's able to be, and he says, okay, so it's on the Apple Play Store. I'll go to Apple Play Store and download it immediately, and then try to look at it. Okay, actually the thing worked, okay. And then, so how did it happen? Then I'll see that, okay, there's a friend, who's a consultant, and then you find out, okay, this guy was just a friend, he's a developer, he has a coding background, he's not in the team, he hasn't jumped on, he has a day job, but, he helped me figure it out. Or in the case of this Zambian entrepreneur, so the person went out and ran a survey with the potential customer set, and then got, out of 240, got 21 to be interested in using the idea and using the product. And then he went ahead and gave the first person the product, not a physical product, but it's a service, right? And said, okay, this is the service. So for me, the person has shown that, okay, I'm committed enough, put his own resources and got something done, right? And then said, okay, I don't have a CTO, but I've been talking to this friend of mine. There's this other guy who's built something similar. I'm trying to see if I can convince him to come on board and be a co-founder CTO. And then this friend of mine has a finance background, and I've managed to convince him he's going to be a co-founder CFO. And I look at the person's background. The person is legit. He's got the right reference. So immediately I see that this person is making an effort, right? You're showing signs that, okay, who to bring on the team, where to find them, what to touch first. But the critical point in that is that the person was able to find a niche customer. So I know that if I help this person build a product, he already has people that will use it. Actually, the last 2 investments that we've made, that was one is in Uganda. The entrepreneur managed to build a niche product and already got customers who are using it and paying for it, even though the product is not fully built. Right? He built the main functionality that the customer wants. Money to get a couple of friends, one a developer, give them some equity in the business, and then this, money to build it, is already selling and getting customers. And already found a salesperson in another big market, and that person is already getting customers every day. So for me, that business is validated, because I know that if this person then finally builds the main product, there's customers that will pay. So in other words, my conclusion to this answer is that fundamentally, you're in the business, you're in the business of looking for customers who will use your product. Make that 80% of to 90% of your efforts. You see, if you do that so well, we the investor will be looking for you. Actually, that's the easiest way to raise. Because, and there was an entrepreneur who invested in, sent me a deck the first time, I didn't respond. But I read it, and I know he figured that I read it. And then 6 months later, he sent me a follow-up deck and said, I sent you an earlier email, and I said I'll do X, Y, Z. In the email body, he showed me what he's been able to achieve in the 6 months. I responded immediately. Because that person, made me a promise. I didn't respond. But now he showed me, look, I've been able to do X, Y, Z. So I know that this person has the ability to execute, right? So sometimes if you send a deck to an investor, we all read the emails. If he doesn't respond, don't worry. Wait and get some traction, and then go back. And in your follow-up email, say, look, I sent you this email, look at my traction the next day. He will most likely respond.
Actually, when you talk about that last point is investor updates, where good entrepreneurs tend to, after reaching out to an investor, whether an investment is made or not, you reach out to mentors, you work with partners, is just continuously keeping them up to date with what's happening in the business, like continuously emailing them, whether it's month to month or once every quarter. You send it's just a one-page email that says, number of customers has grown to this, we've been able to achieve that. We are trying to achieve this. You are able to connect me to my challenges are, I need to be connected to this, I want to do this, I want to do this. Sometimes people are able to then say, oh, you want to do that, I can connect you to this person. But it actually then starts to build up a story of this is a team or an entrepreneur that is actually taking on challenges and going out, finding customers and building and connecting them to the product. So now,
and if I can add one more thing to that, that process, what you're doing there is you're also building a relationship. All relationships are all about communication, right? So that information sharing that you're doing, the person you are beginning to, remember the relationship you talked about, the first 3 people, the family, friends, and food, they are all relationship based. So by doing that, what you're doing is that you're building a relationship with the investor, and slowly the person will eventually, the last thing before we open up is that you will get a lot of no's. And investors don't invest for a lot of reasons. And actually, the tough part is that when you're an entrepreneur, you take it personal and say, why is nobody investing in me? Right? Why didn't investor even respond to my question? This is hard to absorb, but the reality is that majority of the time is that what you're doing doesn't have an exact fit with the investor, or there are not enough investors in the space in which you are, or there are not enough people that know what you are doing. So when you don't get a response, the most likely that you take it personal, but you shouldn't take it personal. Most of the time, for example, when we started, right, like I said, we started investing in the kings. So we said, Africa has 54 countries. You can't start investing in all of them. I mean, I know Africa very well. I built businesses in about 34 countries, and I know how hard it is. But when I wanted to start, I said, let me focus on the 5 countries that I know very well. I know I have relationships there. So there were entrepreneurs who emailed me who were friends from Zambia, from Uganda, that I never invested in.
I was one of them who used to email him.
Right. And also I can't respond to all the emails, right? So if the person didn't respond, don't take it personal, right? I know that it's hard to sort of absorb, but the reality is that majority of the time, I think Barclay is here, right?
Yeah, he is. Yes.
Yeah. So majority of the time, it's a lot of factors not related to you. It's mainly that maybe his thesis is different. So, for example, you're not in the market in which he's able to invest in, right? So, if you're not in the Kings, it's just difficult for me to invest. And if I respond to every question, then I'll have so many, every email, there'll be so many emails to respond to. So I hope I've given some context, and I want to introduce. I want Barclay to kind of jump in. Maybe first say a little bit about his experience. So Barclay was one of the entrepreneurs that found me. I didn't find him, which is a very interesting story.
What's the question?
It came from Eric, so I'll let Eric answer.
No. Just an introduction of yourself, your journey, and Barclay's now raised multiple rounds. We're actually in the process of raising another round. But I wanted to share this stage with Barclay because I wanted you to know that 4 years ago, Barclay was in your seat, starting a business, and then came to an event that I was speaking and waited. He never said anything throughout the event. But when everybody left, say, "Hey, I got to talk to you." Anyway, let me allow him to share his experience.
Hi, everyone.
His experience.
Sorry for coming late. We got held up somewhere. So I'm Barclay Paul. I'm founder and CEO of FinAccess. We are a FinTech building tools for savings and credit organizations and cooperatives. We are a 4-year startup. Been in this journey from 2017, but I've been an entrepreneur the last 10 years. This is my second startup. My first startup was a consumer goods business. We manufactured sanitary towels, baby diapers, right off campus. Raised some money for it. Exited the business in 2015. Then started a mobile lending platform. Did it for 1 year. Actually, that's when I met Eric. We were a mobile lender. Then after a few interactions, because we were trying to raise money to kind of sustain ourselves, then raising money to give customers for balance sheet. That was too much. So that's how we kind of pivoted from being a lender where we are putting our own money on the line to being a platform where we're enabling people who have balance sheet but lack distribution to do the same. So now we are in Kenya, we're in Uganda, we're trying to get into Zambia. That's why we've been here this week. I don't know what questions you'd want to know.
I'll ask the question. So we were just going to open up for questions, but I think we've talked with I think we've gotten the view from Eric as an investor. I think the question then is, at what point did you decide you needed to raise money, and what was your process of finding your first investors to put money into your company? Let's start at that end.
I guess. So first, from building a business, I see a lot of noise nowadays. So I'll work backwards, right? So now there's many rounds being announced every other day. If you check TechCrunch or all these other Africa, they're just Africa. They're all announcing rounds every day. And I feel like people get carried away by the announcing of the rounds. But two things for me come into mind. That one, you need to build a business that actually makes sense. So you're thinking about your unit economics and having paying customers. So investor money shouldn't substitute your customers, because at the end of the day, at some point, somebody will want their money back, and you'll have no way of giving it to them. So fundraising has this hype and all these things around. Here's the money, but there's a day that investors want their check back 3x. So if you're sitting on their money, then that's a problem. The second thing is understanding what you want from a growth perspective. So if I can get 2 customers who pay me and I'm able to meet my payroll and my admin staff. I mean, that's good. So if you're thinking of accelerating that growth and you think you lack money to do it, then you'll think about looking for investors. So not the money will not bring customers also, right? So you can have the money in the account, but if your product doesn't make sense, if you're not solving a real problem that customers are willing and able to pay for, then again that becomes a problem. So that's how I'd like to look at it.
Yeah, I love that you've nailed down that point. I think having had a lot of conversations with, because we work with entrepreneurs, people who want to start businesses at idea stage, and coming into helping people get into the market, is I see a lot of decks where people are like, okay, great, what have you done? Have you got the platform? Have you built it? Have you talked to customers? Like, what's going on here? I'd be like, yes, but I need money to do X. I'm like, yes, but I don't know any investors that will invest in you if you don't have any customers. I don't know any investors that will invest you if you haven't built the platform. I don't know any investors that will, at least if you show some proof of what you're trying to do, I at least because we don't really have a lot of friends and family stage here, I don't know many investors that will invest us. So I love the way you've both brought it back to, can you prove that there are customers willing to buy or test the product and willing to pay for the product to be able to get there. So I'm going to open it up now because I also have to be observant of time. But any questions from anybody? Any hands? I'll bring the mic over to you. Yes, Michelle.
Thank you. Question for you, Eric. Simonza mentioned. Huh? Oh, okay. No, because Simonza was talking about, when you see a founder who's built an MVP and they have a bit of traction, they have customers, they're paying customers. What have you seen in an African context, considering how difficult it is to run a business in Africa? What have you seen as interesting traction versus underwhelming traction? Like at MVP, like first traction stage. I'd be interested to hear what that looks like.
Yeah, very good question. So I don't know if you heard that. It was, so founder has built the platform or team has built the platform. It's in the market. They've got customers. What's your sense of reading traction that says this is good? This is traction that has got potential. Or what do you read that shows you there's potential? Or what do you read that says, yeah, there are customers, but I don't see growth in potential growth in here? Yeah.
I think the critical thing is to be able to show that this customer growth is going to be going up in some form, right? And normally they say month-on-month growth, right? And different VCs set different parameters. Some say 20% is enough. Recently I spoke to a global VC who said it has to be 250% or it's not growing fast enough. Right? So everybody has sort of what they're expecting within that. So part of it is also sort of knowing that, okay, these VCs want 250% growth month on month. But what is important is growth on what? Is it on your revenues, your gross revenues, your net revenue, users, So different VCs have different elements that they look for. What you need to be clear as an entrepreneur is that what is the critical matrix of growth for the business you're building? And then you need to communicate that to the investor. Say, in my business, the main metrics of growth is users, because my main revenue source is subscription. So I want you to measure me by the number of users that I'm getting every month. So if your user base is then going 20% month on month, and I'll say, okay, this fits within my matrix. Because if you're charging a margin of $2 and you're going 20% month on month, and you got 20 this 25 and it's going to go at 20%, then I can do the numbers. I can say, okay, so you're going to be able to make this kind of revenue. So in a year, this is what you get to. I can say, okay, so the business can be growing at the level that I want, right? So you need to be able to figure that and every investor has what they look for. And one of the things that we try to do is, you can also use that as a way to set milestones for growth. Because one of the things that I think Barclay alluded to it indirectly is that you also don't want to raise too much money too quickly, because you give up too much of your company. When you are raising money, you're actually giving up control in your company. So one of the things that you need to think very carefully as an entrepreneur is you want to eventually have majority control in the business. So when you raise too much money too quickly, one of the things that a lot of entrepreneurs don't pay attention to is that you're also losing a lot of control over the business too quickly. So if you don't meet the targets, one of the things that investors do is that now they start clawing back. So the classical situation they have in the market today is people say, oh, I can grow my business by 200%. Okay, the investor will give you the money. But 6 months down the line, if you're unable to grow that 200%, then your next round, you're going to have a down round. Or the investor will say, yeah, you promised us you're going to get to this number, and you couldn't get to that number, and therefore... So the market always adjusts itself. Indirectly, that's what Barclay was alluding to. So all these big raises that you're seeing, where the business is not strong on unit economics, you'll see that eventually the market will adjust itself because the day of reckoning will come. And so the fundamentals are still very, very important.
Yeah. Especially when you talk about unit economics and customers, that's something that people need to be able to read well. Do we have another question? Jason. All right.
Hi. So many questions. But I think I'll just stick to the one. I'll stick to the one that. So we're at MVP. We're about to launch. We're almost there. We're just buttoning it up. We've also got a roadmap of what features that we want that we didn't figure out that we couldn't spend development time on those. So the next step for us is we want to hire more developers so that my CTO can handle off the tasks to those guys. My main question is, how do you guys investors feel about operational budgets and costs? Because I'm tired of eating ramen noodles, you know what I mean? So, and I'm sure a lot of us in the room, we want a car that works, and we want to be able to pay ourselves a salary. We want to pay our staff the right salaries, So how do you guys as investors feel about spending your money on our operational needs? Yeah, thanks.
But I'll let Barclay give. Barclay has a very practical experience.
Yeah, Barclay.
I guess that has changed from, say, 4 years ago, right? Nowadays, you're seeing pre-seeds that used to be Series B for African startups, right? Actually, there was a 32 million pre-seed this week in Ghana. Crazy. Yeah. I think for entrepreneurs now, our biggest skill, if you're a founder, is storytelling. For an investor like Eric, is to paint a picture for them and tell them these are going to be sunk costs, but this is what you're going after. And if they believe that the team going after the problem is good enough, the execution maybe from previous startups or something else was good, then a lot of people are now not fixated around those costs. And so for me, it's more what picture do you paint to investors? Yeah.
Can I use the opportunity to introduce the FinAccess team?
Yes, the FinAccess team is here.
Eric Barclay touched on the team, so there's three other colleagues here. Are they outside? Okay. I really wanted to introduce the team because one of the things that Barclay was able to do very well is being able to build a team that can execute, right? So once you can show that you need a high-end AI developer, because this is a critical part of the product, every investor will understand it. But finding that person and making sure this person can add value to that process of getting the customers and making the product more sticky is really what you have to, which is the tricky part. Every investor knows that, look, you need to drive a car to work, right? But like Barclay said, you need to be able to connect it to, so it will lead to the light being brighter, as I said, right? So most of it, you have to be able to make that connection. And a lot of entrepreneurs sort of don't make that connection. So there's a bit of, it's relevant, but there's a break. It's almost like, okay, I know you need people, but why do you need 10 people? because I need somebody who is a front-end developer who is a different skill set. I need somebody who is a back-end developer. I need somebody who is an AI person, that kind of stuff. Just being very clear and specific.
Also, just to add on that is for startups, when you're very early on, you don't employ for salaries, because if the next person pulls up and they give them 20% more, they'll move. You need to work with people who are believers in what you're doing, because this journey is freaking lonely and very frustrating. You were looking at doing an investor update every month, and like last month and this month nothing has moved. You're like, what am I typing, right? So if you surround yourself with people who are there for the paycheck, then it's going to be disastrous, and at some point. The kind of commitment you'll want from somebody is not an 8 to 5 job. Like startups are not 8 to 5. It's 24/7. You have like a whiteboard in your house where you finish what you did from work and continue like trying to figure out like what's happening. Trying to talk to customers, trying to understand how you can solve the problem better. So the team that you surround yourself then becomes everything. It's the early, maybe the first year or first 2 years, the team around you is everything, and don't use money as an incentive. A lot of startups now have the stock options plan, so make the people who come in early owners of your business, so that they know that even if you're suffering now, when the upside comes, they'll be part of it. Yeah.
Actually, that's one of the things that we did with FinAccess in our early days. So the founding team won a piece of the action, and they stuck around with us till now.
Great. Raphael?
Thank you. My question. Yeah, I'm about to release an album. Yeah. So my question is around policy. You as an angel investor across Africa, is it something that you look at depending on which country you want to get into? How important is that for you as an angel investor getting into new markets, and the policies that govern especially startups in that environment?
Right. So we generally look at the macro factors and the micro factors. So the macro indicators must be looking up. The good thing for Zambia is that in your last election was a big success. The new government is doing a terrific job of trying to sort of get the country back on a strong footing, getting the macros right, so stabilizing the currency situation, trying to fix some of the things that slow things down, bringing new vision and new energy and new thinking bongo hype where you can show up and say, hey, I have this idea about doing this thing. And somebody will say, okay, talk to this person, or come into a session where we get people to ideate. So all these elements are things we look for. Today, I don't know how many innovation hubs and incubator accelerators you have in Zambia. I'm sure that you've lost count. Yeah. Eight. Right. But, there was a time where there was none, right? So the pioneering effort is super important. And these are also things that we look out for when we go into markets.
I guess just to add what Eric is saying is from an entrepreneur's point of view and being in the market for a long time is the upside of the TechCrunch news that you see is people are starting to be educated on VC as an asset class on the continent, because the reason why Silicon Valley exists is because people understand that I can give a young person money to start an idea, and that idea can possibly be something. In my country, people buy land and start all these things that are not startups. So the news that we see of Africans raising capital is creating that awareness that, okay, there's an asset class that is growing on the continent and people should participate in it. But also, we're also seeing a lot more founders being part of collectives that invest in other founders. Because it's easier for me to look at you guys and see myself where I was in 2018 than it is for somebody who's worked in corporate to look at you and wonder, why don't you look for a job? So it's different because of where people are coming from, right? Yeah, where people are coming from. And so the more we have Africans raising money, the more startups, and also in your ecosystem, a lot more companies raise funds and founders become more liquid, then the more you'll see a lot more activity in hubs like this. And that's what is actually powering the Nigeria ecosystem. It's other startup founders investing in other startup founders. And I'll introduce you, I'll give you my money, then after that I'll introduce my investors to you. And then that cycle kind of rotates. So I think this is a good start.
Yeah.
Yeah.
And in Zambia, you're not getting Zambian founders raising substantial rounds. And what's the latest company?
I think Union.
Yeah, it's very good. So, there was no union before. It's very soon there'll be more unions. I hope a lot will come from this room.
Yes, thanks. So in the spirit of investing in the jockey more than the horse, are there, in your experience dealing with African entrepreneurs and entrepreneurs in Africa, are there, I don't want to use the word challenges, ever the optimist here, but are there particular areas for room of improvement that you'd say that the African-based entrepreneurs need to focus on when it comes to interacting with investors and scouting for investment?
I think the main shortfall is probably educational. So you see, our education institutions, unfortunately, don't groom entrepreneurs. When you go to a classic African education institution, if you're an entrepreneur, you sort of change course in that process. So that's the first challenge, which it's systemic, right? It's going to take time. I think now there are more and more private universities that. But I think the FinAccess team is here. Did I see Nicholas? Is it Dennis?
It's possible.
I really want to introduce the FinAccess team.
Okay. Answer the question, Wood.
Yeah. If you can check that, I want to come out. These guys, we've been up early and been in meetings, but the great thing about this entrepreneur is all about people. So anyway, sorry about that. But
hi, how are you doing?
So
are you from the FinAccess? Great.
Sorry, what was your question? So the first thing I was kind of leading to was sort of the educational system, right? So our education system has not been at par, but this is going to take time. I think there are more and more private institutions that are looking to entrepreneurship, IT, technology, innovation. So I wanted to sort of briefly stop and introduce the FinAccess team that are come with us. So I'm so proud. You know, when I started with Barclay, it was a predominantly male team. Today, the senior management is predominantly female. He's the only guy. So Mweni is our CTO in the is that red dress, and then maroon, not red, correct. And then next to her is Nick, who is our head of special projects. So Nick is going to be spearheading this growth effort. And then Dennis is the one still in suit and tie, still hasn't given up on his tie. He's the head of the product we're bringing to the market called Growbox. And these are the, section of the live team that make FinAccess work and been out here with me today. So anyway, to conclude on that, so the educational system is very important. But in the absence of that, I think a lot of entrepreneurs try to push themselves. So generally, there's some level of deficit, right? And part of that deficit also comes from the way you engage with investors. So building a company is classically a science. Raising money is an art. So so in this game, you're gonna have to employ two streams. And if you don't, and there's sort of they run in parallel, but they also kind of meet. So you have to kind of understand how investors think, what they look for, trying to engage with them. But I say 80% of your time should be on the science of building your company. The final part of that is that the reason a lot of, and here I put foreign and investor commerce, entrepreneurs are able to raise money is that they almost are within that trolls. So they have networks of family, friends, and investors that they can go to and easily say, okay, then they give them the money, right? But when you're an African entrepreneur, the biggest challenge is that you're not in those circles, right? And so one of the things that we try to do at Chanzo Capital when we started Angel Fair Africa, this was the big problem we wanted to solve, was that it was clear to us that African entrepreneurs run in circles that doesn't coincide with investor circles. So they're African investors, right? Either the person invests in a lifestyle business, a family office, or an individual, right? It's not very formalized, but you're not connecting with that circle, right? So what we try to do with Angel Fair is create that opportunity for every year we select a number of entrepreneurs. We can't select everyone, but we bring them into the room with investors. And that actually has been a catalyst for a lot of the investments that you see today. And sorry that I'm not trying to take too much credit, but when we started this in 2013, people said there was only Shark Tank and Dragon's Den, but wanted to build an African version of it, right? And every year we go to a different country. And when we go to a country, we use it to spotlight the country, to build the ecosystem, bring international investors, but also bring local investors. Sometimes when the local investors or a local successful entrepreneur sees that, oh, there's an event, there's international investors, they say, okay, I want to go there. Oh, they're entrepreneurs, I want to invest, right? So it's kind of a catalytic, effect that we've created over the years, and today it's snowballing. But it's not in every country. So hopefully we're seeing it in Zambia, it will become more, and then Uganda and other countries.
Great. Do we have one more question? Oh, sure. All right. Final question.
Okay.
Can we
hello.
add one more?
So this is
chasing time as well. Okay.
with regards to key man risk. So normally startups have that feeling of ownership. Like I've been with this business for the past 5 years. I won't let go of it. And that threatens the long-term success of the business. So as an investor, obviously now that's after adopting that, okay, this idea is profitable and this business is destined to get greater heights. There's now a point where maybe they've built an app, then there's a programmer who's got a code. With that feeling of ownership that most startups have, how do you deal with that as an investor, knowing so that you've got your resources with this startup, and how do you make the co-founder believe that the business is greater than the individual, so that all key individuals, to eliminate the key man risk, work towards the success of the business?
Right. I'll try to give a brief answer so that we can take the last question.
Yeah.
So it's a lot of it has to do with the founder or co-founder's mindset. So one of the things conclusion that we've come to is that there needs to be a certain level of the mindset, and if it's not there, we will not engage. For example, when Barclay and I first talked about having founder shares for the founding team, the next thing was, okay, how do we do it? I didn't have to convince him. It was clear that there were guys who were there with me from the beginning who, I couldn't pay market rates, but they believed, like you said, they believed in my vision. So it was just a matter of how much do we give them, and then we sat down one day and we just did it. Right? So for me, it's easy. But if I have to now convince you that the people that you started with, yes, they are not co-founders, but they're founding team. They took a risk. They could have gotten a job at a bank or worked somewhere else and made better money. So you have to think about them. And for me, if you're not thinking about them, then,
Good evening. My question this evening is, what is healthy equity? According to you, what's healthy equity? That, for example, a startup, you can consider investing in a startup, and what would a partnership look like, if at all you are thinking of such kind of partnership?
Right. That's a good question. So generally, actually from Chanzo Capital perspective, we fundamentally believe that the entrepreneurs and the founding team need to always own majority of the business. By the way, and this is something that you, the founder and entrepreneur, also think strongly about. But you don't need to own 100% of nothing. So here's the tricky part, right? I want you to own majority of business, but owning 100% of nothing is not as good as owning 70% of a big pie. So you need to, in your mind as an entrepreneur, think, how much of this business do I want to give away to investors or to my founding team? And how would that help me build that bigger picture that I want to achieve? And this is an exercise that you have to rigorously do, so that when you are raising money, you know that eventually I will be giving up this amount of the business, but I will then be able to build a big enough business because I've been able to give equity to my founding team, investors who helped me, and people who brought value. Because you cannot be alone, right? There's no company that's owned by one person that's $1 billion company. When we talk about Amazon, even though Bezos' name is always on Amazon, but there were people who were there from, I think the CEO now was a guy who was there from the beginning, and today he's become the CEO, and all these guys own stock in the business, right? So I don't give you a definite answer. The definite answer is that we believe that the founder should, because the day the founder doesn't own majority in the business, you lose interest. So we always want the founder to own majority of the business. But you also have to calibrate how much do I give out to incentivize the other people that help me achieve the vision. And you need to be clear on this so that you can communicate it to investors. It's one of the things that helps investors, okay, this person knows exactly what they want and what they want to achieve, and it creates a lot of certainty.
Oh, great. There's one person, short question, straight to the point. It's almost 8, and I'd like to respect your time.
Okay.
Yeah.
Actually, time flies.
Hello?
Yeah. Okay. So you won't hear it. Just...
Okay, so I wanted to add a note and then also ask my question. I don't know if you can. Straight to my question? Okay. My question is, how do you help businesses break from, when we first start business, we start as entrepreneurs, and then we eventually run a business with a few employees, and then you find a time when a business grows and probably it has hit a certain, it has broken into a certain financial bracket. But then typically of most businesses and entrepreneurs, they still kind of like control all the information. I mean, the running of the business, and yet they want to, they need to grow now to have a full team that is also growing. Okay. Now, as an angel investor, how do you come in to help
have experiences that will help the business go to a different level. When I was an entrepreneur, one of the businesses I built, there was a time where I was no more the CEO. I just became a board member. And I remember my friends saying, "Are you crazy?" But for me, it was clear that the business needed to run at a different pace, needed a different phase, a different people with different skill set. I was still the majority shareholder, and I was just a board member. I was a chairman, I was in the chair. But for me, that business had gone to a point where it was bigger than me. If I tried to hold, that business would have declined. And this is where a lot of entrepreneurs don't realize it. It also goes into sort of everything, including running government and running a state. You have certain abilities. You have to know where you reach your threshold, and you have to know when you want to hand over to someone. It's a big sign of maturity. And one of the reasons I succeeded is that I knew when the ISP party was over. Remember, my other founders didn't know that the party was over. They still thought, oh, no, the big guys in town. And by the end of the year, they didn't have a business. So it's a difficult thing to do. The passion, you need passion, you are so married to the business, but you have to know when to let go. It's a very, very important attribute that you have to learn as an entrepreneur through the journey. And it helps you unlock the value. Otherwise, you create all the value and the business declines because you didn't see when it was necessary to bring other people to handle.
Yeah, thanks a lot. Thank you very much for that, Eric, and thank you very much, Barclay, for making time to join us. And like I said, having community events like this is something that we find very, very not only inspirational and motivational, but very educational with regards to the journey that we're going on with entrepreneurs. I just need to add to there as well that the VC class that we've been talking about here is not the only way that companies can raise money. So it matters about the type of business that you're doing and what the growth opportunity is there for the business and what the needs at the stage that the business is in. You can either go for debt, so you can go for other versions of class. So when we're talking specifically towards angel VC, we're looking at potentially high growth companies. Traditionally, that is what the VC class would be looking for. So just bear that in mind so that you can weigh out when you're looking at talking to whether you want to talk to investors. If you're building what you'd call a dynamic or a family lifestyle business, it might not be what. It looks for a different type of financing as opposed to building what would be here. So now, with regards to how can we help? A number of programs that work with entrepreneurs at idea stage, market entry, and then investor readiness. One of the programs we're currently running is the Women in Tech program, which is in a partnership with Standard Chartered that is working with 12 amazing businesses that are female-led that we're working together to run around customers, they getting to understand the unit economics, what the levers of growth are, to help them set a plan for where they want to grow and how to get to achieve that. And hopefully, now that Eric is finally investing in Zambia, we can get to chat to investors like Eric and others in places like this. So at Bongo Hive, we like to say that we work with great minds building viable solutions that will change the world. We hope that the great minds that are here will continue to build viable, strong businesses. George, do you have anything in closing? All right. So George doesn't have anything in closing. You have a good night, everybody.
And thank you, George, for putting it together. That was terrific.
Thanks to George for
making it happen.
Yeah, Eric sent me a message Saturday, Sunday. Yeah, sent me like a WhatsApp message like, hey, I'll be in Zambia. Can we have something? And then George took over the conversation and set this up. So grateful to him for that. So yeah, great thing to do as entrepreneurs is network, get to know one another. Eric and Barclay are still around if you have questions for them. Soaks are serving drinks. You can buy drinks from Soaks outside. We support entrepreneurs. Buy. So buy from Soaks outside. Bye.